Coronavirus may spur a capital flight from the United States and weaken the dollar, according to our next guest, Kunyuki Hirai. He is head of trading for MUFG America. So before we get to some of the long-term issues with capital leaving, what's happening to the dollar, let's just talk about today.
Right.
This morning, the Fed coming in, making an emergency cut outside of the meeting schedule. How surprised were you?
So it was surprising, first of all, because we knew that there was a coordinated phone call among G7 finance ministers and central banks. And we knew that they would have something, but turned out to be just a communication type of coordinated phone calls. But soon after that, the Fed comes in and they did standalone rate cut, 50 basis point, having a Fed meeting 2 weeks from now.
Yep.
So that was pretty surprising to me.
And I guess in your view, is the Fed acting alone here? Because I mean, we've seen, the end of last week, we saw the BOJ make a small tweak to some of their asset purchases. I think the ECB has been a little quiet, all things considered. But everyone knows that when the Fed acts, most central banks will follow them. The Bank of Canada today saying they're probably going to cut. So is the Fed, do you think, forging its own path, or might they have let their peers know this was coming?
So that's a very interesting point. And when we look in the past, like Lehman shocks and all of that, there was also a coordinated rate cut. So it was announced that they would have something because they gathered together at that time, and there was 5 central banks cutting rate in the same time. So market was expecting that way, I think. Market, expectation is nothing to do with Fed or other central banks, but there was some kind of heightened expectation toward that type of intervention. So to answering your question, Fed for sure did not act alone. They coordinated somehow, but it was not like coordination that market expected, I think.
And I guess to your point, you bring up the Lehman example, which everyone's thinking of today. It's the last time we saw an emergency cut. The stress then was in credit markets. And I think, we kind of just saw a blow-off rally in the 10-year in the last couple hours here. But generally, and I don't know if this is your view as well, credit markets have been reasonably well-behaved. I mean, do you think that the Fed and other central banks are worried about a credit crunch if right now equities really seem to be the source of pressure?
So it's a preparation, right? Preparation toward a possible credit crunch or whatever. But to your point, you're right. The market condition or financial condition is so different compared to Lehman shocks, where we had a lot of stress in the credit market, whereas here we still have ample liquidity. Interest rate is much lower than before the Lehman shock. So I don't think that it's a credit event right now, but I think Fed wanted to prepare for a worst case scenario.
And then quickly, with the interest rates going down by 50 basis points today, if the differential is getting smaller, in theory, I guess there should be some outflow. What are you seeing in the U.S. dollar so far? What do you expect to see from, basically where capital is going around the world?
Right. So purely from interest rate differentials, you're right. For sure, Fed has more room to cut, and compared to like ECB or BOJ. So technically, interest rate differentials will be narrower and narrower. So U.S. dollar is pressured toward downside. But in the same time, the development of coronavirus, for example, in Asia started faster than the United States. So that also may drive U.S. dollar in a weaker side, because under the anticipation that U.S. coronavirus cases could increase, and China and Japan cases could stabilize.
Right.
Kunyuki Hirai is America's head of trading for MUFG. Thanks so much for coming by.
Thank you.